What will be the catalysts and what are the biggest risks right now in Hong Kong, China?
Well, actually, we remain risk on and we continue to be invested. Now, markets has gone up a lot. If you look at MSCI China, for example, it's up 26% year to date in US dollar terms. But we do believe that the market has gone up because the most likely and the central scenario is one that is fairly benign global macroeconomic conditions. Growth is solid, it is broad-based, inflation is beginning to recover, but it is strong enough to be positive for revenue acceleration, but actually weak enough to keep central banks quite cautious. So with regards to that, and because of that, earnings we think it will continue to deliver quite strongly in the next 12 months to come.
Even though PPI, the pace of growth, has moderated a bit, you still feel there is a reflation story for the global economy coming out of China.
Yeah, indeed. China is still reflating. I mean, it's not growing as fast as it was in Q1, where growth was spectacularly strong. The nominal growth was as high as 12% year on year. But we still think that PPI running at about 5 to 6% pace, it's constructive for a recovery in the return on equity.
Let's talk about some of this. Well, let's talk about the stock market in particular. It seems as though the market kind of shrugged off the Moody's downgrade of China and Hong Kong. What's going to be the next catalyst or big event that we're going to be seeing? I know MSCI is reviewing their possible inclusion of A shares on their review on June 21st. What do you expect?
Our view is that it's a close call. We're not holding our breath about the potential inclusion of A shares into MSCI indices, mainly because the government is still insisting on a pre-approval process for financial products, which MSCI may not agree to. So why then are we continue to be overweight in China? And I think the key reason is because of earnings. Earnings revision is running at the best pace in 6 years. And if you look at valuation as well, it's still running at maybe 20% below historical average. So when you have earnings recovery, you have reasonable valuation, and at the same time, the banking system, we think it's running it at a quite a robust pace now. I think with that in mind, we're still seeing positive returns in China going forward.
Yeah, but what is going to be the risk, though, of overshooting on the crackdown on leverage?
This is a very important point because what has happened is that the government has actually taken opportunity of the very strong growth to tighten liquidity conditions, credit conditions, and to deleverage the financial system. Actually, that is positive for the sustainability of the market. And the reason why we are reasonably sanguine is one, the tightening has been rather orderly. And two, the government is moving from a position of strength. And once growth were to recover, as we are seeing in China and also in the rest of the world, one should expect central banks to start to withdraw some level of monetary policy accommodation from the market.
Now, we talked about, of course, the potential inclusion of A shares in the MSCI global indices. I want to bring up a chart. We won't be able to see it, but our viewers will. Watching at home or in the office. Hashtag BTV space 9280. Basically, it's showing the spread between what we oftentimes track for H shares here in Hong Kong, the HSCEI, and what a lot of global money managers look at as the MSCI China. It is the spread between these two is now at a record high. Are we not seeing the true representation of the China economy through the HSCEI, which is mostly financials, industrials, no tech companies, where MSCI China, it is loaded with Tencent, which created about 1/4 of the Hang Seng gain this year, and also Alibaba?
I think, Steve, you brought up a very important point about China. This is a market that requires active portfolio management because it is an economy in transition. And when there is transition, there will be winners and there will be losers. So what you really do want is to be buying the transformation and the growth in China, not trying to equitize its debt. And what we are seeing is that the new China index that is loaded with tech companies as well as the new economy sectors have actually outperformed the old China index by about 7.5% per annum since 2011. So indeed, MSCI H shares is a far better representation, has a far better representation of what's growing in China versus the rate chip index.
Can I ask you a quick question on the Bond Connect? They're finalizing the details here, but it seems as though money managers, foreign money managers, not too keen on it right now. Capital controls are concerned. The veracity of credit ratings agencies in China, of course, concerns about liquidity. Do you think eventually that Bond Connect will pay off? Because this is, what, the third largest bond market in the world.
Yeah, I think with the Connect program, we've seen that implementation can be an issue and the initial traction can be difficult. This was the case with the Shanghai, Hong Kong Stock Connect as well. But if you look at the evidence today, it's been a hugely successful program. I do think that the Bond Connect is a very important and a very strategic move, because there has to be a way for foreign investors to gradually buy into the Chinese market, and eventually the southbound leg of it will also be open, and therefore gives the Chinese household and Chinese corporates an opportunity to diversify into a broader universe of instruments.